In microeconomics, consumer behavior refers to how consumers make decisions to spend their income on different goods and services to gain highest utilities. Besides, consumers also aim to maximize satisfaction with limited income they have. For example, this is two products that give the same function, but the price and the quality is be compared by the consumer use their own preference. Next, the law of diminishing marginal utility states that when consumption increases, the satisfaction of additional one unit will decrease. For example, when consumers drink the first bottle of water, they will be very satisfied. But when they drink the third bottle of water, they will be less satisfied. This shows that when they consume more units of the same goods, there will be less satisfaction. This consumer behavior important to the real world economy because it helps consumers to make better choice. Next, in the theory of distribution, it refers to how income and wealth are allocated among individuals. It also has determination of wages, rent, and profit. Its importance in the real world economy because it can shape policies that can promote sustainable income distribution. Objective to know all this is to learn how consumers evaluate utilities to apply knowledge in personal life. Besides, it helps to make smart saving and investment choice to predict market trend in production development.
So, firstly, in theory of consumer behavior, we have utility analysis. Utility analysis can be defined as how consumers make choices to get satisfaction from goods and services. It helps to understand consumer behavior and also provides a framework to understand consumer decision making. There are two types of utility, which is total utility and marginal utility. So, what is total utility? Total utility is the amount of satisfaction a person receives from consuming a certain quantity of goods or service. For example, the first slice of pizza gives high satisfaction, the second still gives choice but less than the first. So, how to calculate TU? Using formula to get total utility is must sum of all the satisfaction we get from each unit of a good that we consume. Next, marginal utility. Marginal utility is the additional satisfaction gained from consuming one more unit of a good. For example, if total utility from 2 chocolates is 20 and total utility from 3 chocolates is 25, then marginal utility is 5. So how to calculate MU is by change in total utility divided by change in quantity. However, in real life, a consumer may consume multiple products at the same time. Therefore, the additional satisfaction marginal utility may be affected by the combinations of product consumed. It is not just a single item. For instance, if a consumer eats 2 slices of pizza and drinks 1 cup of soda, and the total utility increased from 50 to 22 liters, then the marginal utility is 7 liters. The law of diminishing marginal utility states the utility or satisfaction gained by a consumer from each additional unit of a product decrease as total consumption increase. The consumption of other products remains unchanged. When marginal utility decreases, the total utility increases at a diminishing rate. Besides, it shows that marginal utility decreases with each extra unit consumed. There are two main approaches to explain consumer equilibrium. First is the cardinal utility approach, that is defined as a consumer is in equilibrium when they allocate their income in such a way that the last ringgit spent on each goods give the same marginal utility per price. Next is the ordinal approach when consumers do not measure utility. In the ordinal approach, an indifference curve shows the various combination of goods that give the same level of satisfaction. This shows one of indifference curve characteristics, which if the amount of goods consumed increase, the utility derived from consumption also increase, and the consumer will move to a new indifference curve, which represents a higher utility. Consumer equilibrium is attained when a consumer chooses a combination of goods that maximize their utility at a given level of income.
So right now I will explain about determination of wages. Refers rent market. Wages are primarily determined by the interaction of demand and supply for labor. There is two key concepts in wage determination, which is demand for labor and supply of labor. So right now I will explain about real wages. What is real wages? Refer to the purchasing power of money received by the worker. It applies to the total necessity, benefit and facility and comfort the worker might enjoy. So I will explain about demand of labor. Demand of labor is a liberal demand. It can be defined for factor of production. Labor is demanded by firm, producer or supplier to produce goods and service in the economy. A firm demand curve of labor is determined by the marginal revenue, which means how much extra output and revenue each additional worker brings. After that, supply of labor come to individual or household who seek to earn wages or salary within a certain time period. It can be a perfectly elastic, upward sloping and backward bending. The supply of labor may be analyzed from three different perspectives. First, supply of labor in the perfect market or perfect competitive market is perfectly elastic or horizontal. This is because of the fact that in the market with perfect competition, there are many vendors, but each firm is small, meaning there is no seller can control the pricing of goods and services. The supply curve of labor in industry is upward sloping, meaning that the market supply curve is positively related to wage rate. Lower the wage rate, the lower the quantity supply of labor will be. So lastly, supply of labor for entire economy refer to a total number of working hours that individuals in the country are willing to supply at different wage level. The company-wide labor supply curve has a unique shape known as backward bending supply curve. And right now, I will explain about equilibrium, which it is determined by the market demand and market supply of labor. When the market demand and market supply of labor are equal, then the market equilibrium, wages will be attained. The labor market demand curve slope downward, meaning the quantity of the labor taken will decrease as the wage rate increase and vice versa. However, the market supply of labor is upward sloping, meaning that the quantity of labor supply will increase with a higher wage rate and vice versa.
Now, I would like to present about two important concepts in economics, which are rent and interest. I'll begin with the concept of rent from the classical, neoclassical, and modern perspective. In classical economics, David Ricardo defined rent as a payment for using land, which is considered limited and fixed in supply. According to him, rent arises from using land in the most productive way. Besides that, Alfred Marshall, a neoclassical economist, extended the idea of rent. He said, rent is not only income from land, but also from natural resources that are not made by humans, such as forests and rivers. David Ricardo also introduced the Ricardian theory of rent to explain the origin and determination of rent. This theory states that rent arises in two forms. First, scarcity rent. Scarcity rent happens when all land is of equal quality, but is limited supply. Second one is differential rent. This occurs due to variation in land quality. More productive land earns more rent than less productive land. Moving forward, the modern theory of rent is an updated version of Ricardo's theory. It applies to all scarce resources, not just land. Modern economies believe that land is limited in supply and cannot expand when demand increases. As land produces a limited output and demand continues to rise, rent is paid based on scarcity, not just differences in land quality. This is known as scarcity rent. Modern economies explain the determination of rent in two parts. First, the general concept of rent. Rent is determined by the market forces of demand and supply for factors of production. The demand is called derived demand, which means it depends on the demand for final goods. When rent is high, demand falls, so the demand curve slopes downward. Meanwhile, the supply increases with higher rent and decreases with lower rent, so the supply curve slopes upward. Second, we have the concept of economic rent. Economic rent applies to all factors of production, including land, labor, capital, and entrepreneurship. It refers to the extra income or surplus earned by a factor over and above its transfer earning. In the graph, the DD curve represents demand and the SS curve represents supply. The point where they meet is called the equilibrium point. Next, there are three possibilities of supply elasticity for a factor of production. First, perfectly elastic supply. The supply curve is a horizontal line. It means the factor like land is available in a limited quantity at a fixed price. The demand curve slopes downward, showing that lower prices increase demand. Second one is perfectly inelastic supply. The supply curve is a vertical line, showing a fixed quantity. In this case, all the earnings are considered economic rent because the factor cannot be used elsewhere. Transfer earning are zero. And the third one is upward sloping supply curve. This is more realistic case. When rent increase, more of the factor is supplied. Total earnings are shown by the area R in Q, which is rent per unit is R and times quantity is Q. The economic rent is the surplus over transfer earning, shown by the area RP. Next one is interest. Interest plays a key role in the capital market. It acts as the price for capital, meaning it's the cost of borrowing money. It represents the return that lenders or investors expect in exchange for lending their funds. Interest also encourages savings and investment. When interest rates are low, businesses are more likely to borrow and invest in various projects because the cost of financing is reduced. To conclude, rent and interest are both important concepts in economics. They help us understand how income is generated from limited resources and how money flows in the capital market.
Now I'm going to talk about profit. What is the difference between normal profit and economic profit? The first one, when did it occur? Normal profit occurs when total revenue equals the total cost, while the economic profit occurs when total revenue exceeds the total cost. While the minimum profit of normal profit is just sufficient to make sure the enterprise runs, while the economic profit indicates the firm is earning above normal returns. And as we can see, the economic profit has much higher profit than the normal one. And the last thing is the difference of them is for normal profit, it has only one type of it. That's it, normal profit. But for economic profit, it has two types, which is economic profit and economic loss. For government policies or economic strategies that can improve consumer welfare and income distribution, which is contractionary fiscal policy and direct control from the government, where the contractionary fiscal policy will have three things, which is decrease in government expenditure, increase in taxes, and government designs tax system to stabilize its tax structure. While direct control of government have two things, which is income policy that ensure wages do not rise faster than productivity, and price control to fix floor price or ceiling price so that the general price level is kept low. Next, there is suggest ways to enhance wage fairness, regulate rent, and optimize profit distribution. First, let's talk about wage fairness. Minimum wage policy ensures a basic standard of living and reduce income inequality, while progressive taxation, higher earners contribute more, allowing redistribution through public services. And the third one is investment in education and training that will improve worker productivity and access to better paying jobs and link to long-term wage equity. And next, for the regulate rent, the price ceiling on rent government impose maximum price to protect tenants from excessive charges, while public housing programs increase supply of affordable housing to reduce pressure on the rental markets. While the other one is rental subsidies that target financial aid to low-income households to improve housing access. And the last one is optimizing profit distribution. The corporate taxation ensures firms contribute fairly to national income and public goods, while anti-monopoly regulations can prevent firms from earning excessive profits through unfair market dominance. And the last one is profit sharing schemes, where encourages equitable distribution of firm successes among employees. And the last one is real-world examples of successful policies. Where is it and what it is? The first one is Malaysia's minimum wage policy that is introduced to ensure fair compensation and reduce income inequality, while it reflects the emphasis on wage fairness and labor market intervention. As far as we know, in our daily life, there is two, which is RON 95 petrol and cooking oil subsidies government. Subsidies on essential goods to reduce cost of living. Example of price intervention to protect consumer welfare. While the third one is Malaysia Competition Commission, MyCC, that regulates monopolistic behavior and promotes fair competition. And the last but not least is fiscal policy that I mentioned earlier, that actually being used and to curb inflation during the oil crisis in the 1970s.
To be concluded, study of the economic behavior of the consumer is important in understanding how market demand is formed. From the discussion, we can see that consumer behavior and factor rewards both play a big role in maintaining economic stability. When people spend wisely and producers get fair rewards from their efforts, the economy becomes more balanced and efficient. Besides, the importance of factor rewards in economic stability is it can encourage business to invest in expanding production, which can lead to economic growth and job creation. Next, it also influences income distribution within an economy. Government policies such as minimum wage laws and taxation can influence factor rewards and their impact on the economy. As final thoughts, we hope that with more awareness and understanding, both consumer and producer can make smarter economic choices. In the future, they need more practical education and exposure to real-life economic situation should be provided so that everyone, especially students like us, can apply this concept better in daily life. Besides, we must ensure that economic progress benefit all, not just a small elite.